What if I told you that the biggest reason most people fail with money has absolutely nothing to do with math? It is not because they did not study economics, it is not because they missed the right stock tip, and it is definitely not because they weren't smart enough. The real reason most people struggle financially is because of the way they think and feel about money. Welcome back to Mono Invest, the channel where we break down the most powerful financial ideas in the world so that you can take control of your future and build real, lasting wealth. I'm your host, and today we're doing a deep, full breakdown of one of the most important finance books of the 21st century, The Psychology of Money, written by Morgan Housel. Now, if you've never heard of this book, let me give you a quick stat that will blow your mind. Since its release in 2020, this book has sold over 4 million copies worldwide. It has been translated into dozens of languages, and it is consistently ranked as one of the top personal finance books of all time. And the reason it resonates with so many people, from college students to billionaires, is because it doesn't talk about spreadsheets or complex investment formulas. Instead, it dives deep into the human side of money, the emotions, the biases, the stories we tell ourselves, the habits that silently make us rich or keep us broke. So, whether you're just starting your financial journey or you've been investing for decades, today's video is going to give you tools that will change how you think about money forever. Let's get into it. Before we break down the book, let's talk about the man behind it, Morgan Housel. Morgan is a partner at the Collaborative Fund, a venture capital firm. Before that, he was a financial columnist for the Wall Street Journal and the Motley Fool, where he spent years studying investor behavior and market history. What makes Housel unique is that he's not just a numbers guy, he's a storyteller. He spent his entire career trying to answer one question: why do smart, educated people make terrible financial decisions? And after years of research and observation, his answer is both simple and profound. Because money is not a math problem, it's a human problem. He doesn't believe you need to be a genius to build wealth. He believes you need to understand yourself, your emotions, your habits, your relationship with risk and reward. And that's exactly what this book is about. The book is broken into 20 short chapters, each built around a single key insight about how people think and behave with money. Today, we're going to walk through the most important lessons from each of those chapters with real-world examples and takeaways you can apply starting today. Let's go. The very first lesson in the book hits you like a cold splash of water. Morgan Housel opens by saying, "No one is crazy." Now, at first, that sounds weird, because if you've ever watched someone make a terrible financial decision, maybe a friend who blew their whole salary on lottery tickets, or a relative who refused to invest in anything except gold, you probably thought, that's insane. But Housel says, wait, before you judge them, understand where they came from. Here's his point. Every single person alive today has been shaped by their own unique set of financial experiences, the decade you grew up in, the economic conditions your family faced, whether you experienced poverty or abundance during your childhood, whether you saw your parents stress about bills or invest confidently in the stock market. All of these experiences wire your brain to think about money in a very specific way. And what looks crazy to you might make perfect logical sense to someone who grew up in completely different circumstances. Think about it this way. Someone who grew up during the Great Depression, watching banks collapse and savings disappear overnight, might spend the rest of their life hoarding cash under the mattress rather than trusting banks or the stock market. Is that rational by today's standards? Probably not, but given what they experienced, it makes total sense. On the other hand, someone who grew up in the 1990s tech boom might have a high appetite for risk and love speculative investments because in their experience, the market always goes up. Same world, two completely different realities. The takeaway for you,
Before judging someone else's financial decisions, or even your own, ask yourself what experiences shaped this behavior. That's the first step towards financial self-awareness. Okay, this next lesson is one that a lot of people don't want to hear because we live in a world that loves to celebrate hard work and individual achievement. But Morgan Housel makes an uncomfortable argument. Luck and risk are more powerful than most of us want to admit. He uses Bill Gates as the example. Now, Bill Gates is undeniably brilliant. He's one of the hardest working people in the history of technology. But here's a fact that most people don't know. Bill Gates attended one of the only high schools in the entire world in 1968 that had a computer. Think about that. There were roughly 300 million high school-aged kids on the planet at that time, and Bill Gates happened to attend the rare school that gave him access to a computer terminal, a piece of technology that most universities didn't even have yet. That's extraordinary luck. Does that take away from his genius? Absolutely not. But it's a reminder that the line between brilliance and luck is much thinner than we think. Housel also introduces the flip side, risk. He tells the story of Kent Evans, Bill Gates' best friend and equal in intelligence and drive, who died in a mountaineering accident before he could ever build his career. Same intelligence, same drive, completely different outcomes because of risk. So, what does this mean for you as an investor or wealth builder? It means two things. First, be humble about your successes. If things are going well, acknowledge that part of it might be luck, good timing, the right connections, favorable market conditions. This humility will protect you from overconfidence. Second, be compassionate about failures. Not every financial loss is the result of stupidity or laziness. Sometimes things just go wrong. Acknowledge risk as a real and powerful force. And most importantly, build your financial plan assuming that luck and risk are both always present. Never bet everything on one outcome, no matter how certain it seems. This might be the most psychologically powerful lesson in the entire book. Housel asks a haunting question. Why do people who have so much still want more? He tells the story of two hedge fund managers, Rajat Gupta and Bernie Madoff. Both were extraordinarily wealthy. Both had made it farther than 99.9% of people on the planet. And both ended up in federal prison because they wanted even more. Gupta, worth hundreds of millions of dollars, apparently wanted to be a billionaire. Madoff built one of the most successful investment firms in history, but ran the largest Ponzi scheme ever discovered. Why? Because they could never define enough. This is one of the most dangerous traps in personal finance. Housel calls it the moving goalpost problem. Every time you reach a financial milestone, a certain salary, a certain net worth, a certain lifestyle, the goalpost moves. Suddenly, that amount is not enough. You need more. And this trap does not just affect billionaires, it affects everyday people too. You get a raise, but now you want a bigger house. You get a bigger house, but now you want a luxury car. You get the car, but now all your friends are taking lavish vacations. The hedonic treadmill never stops. The solution Housel offers is simple but powerful. Define what enough means to you before you reach it, not in terms of a number, but in terms of a life. What does your ideal life look like? What do you actually need to feel secure and fulfilled? When you can answer those questions clearly, you can stop chasing and start living. And here's the irony. People who define enough often end up wealthier because they stop making reckless decisions trying to get more. All right, let's talk about what Housel calls the most powerful force in the history of finance, compounding. Now, I know you've heard about compound interest before, but I promise you, the way Housel frames it will change how you think about it entirely. Here's the mind-blowing fact he starts with. Warren Buffett's net worth is approximately $80 billion. But here's the kicker. Over 95% of that wealth was accumulated after his 65th birthday. Read that again. After age 65. Buffett started investing at age 11. He became a millionaire at 30. But the explosion of wealth, the tens of billions, only happened because he let compounding work for decades. Housel says his skill is investing, but his secret is time. Think about that. Buffett is not the greatest investor because of some magical stock-picking ability that no one else has. He's the greatest investor partly because he started early and stayed invested long enough for compounding to do its work. Here's a simple example. If you invest $10,000 at a 10% annual return, after 10 years, it's roughly $25,000. After 20 years, roughly $67,000. After 30 years, roughly $175,000. After 40 years, roughly $452,000. The same $10,000, but with 40 years of time, it becomes nearly $500,000 without you adding a single extra dollar.
The lesson? Time is your most valuable financial asset. More valuable than income, more valuable than stock picks. Start early, stay invested, and stop checking your portfolio every day looking for short-term wins. Compounding does not work in the short term. It works over decades. Here is a distinction that most financial content completely ignores, and it may be the most practical advice in the entire book. Housel argues that getting wealthy and staying wealthy are two completely different skills, and they actually require opposite personality traits. Getting wealthy often requires taking risks, being optimistic, moving boldly and decisively, sometimes being a little reckless. But staying wealthy requires humility, fear, the productive kind, frugality, accepting that some of your gains might have been due to luck. He gives the example of Jesse Livermore, one of the greatest stock traders in American history. At one point, Livermore made the equivalent of $3 billion in today's money in a single day during the 1929 stock market crash. He shorted the market at exactly the right moment. And then he lost it all, every penny, multiple times, because the bold, aggressive mindset that made him a fortune was completely unsuited for protecting that fortune. The lesson for you? Once you start building real wealth, your strategy needs to evolve. Shift from offense to defense. This means never risk what you have and need for what you do not have and do not need. Diversify. Do not put all your eggs in one basket, no matter how sure you are about an investment. Build an emergency fund. Before you invest aggressively, make sure you have a financial cushion that lets you weather any storm without panic selling. The goal is survival first, growth second. Housel introduces a concept here that completely changes how you should think about investing. Tail events. In statistics, a tail event is something rare and extreme, at the far end of a probability distribution. Most of the time, things are average, but occasionally a rare tail event happens that changes everything. Here's the key insight. In investing, a tiny number of events account for the vast majority of outcomes. Housel points out that in venture capital, where investors fund startups, most investments fail completely. Many return modest results, but once in a while, an investment returns 100x or 1000x its original value, and those rare wins pay for all the losses combined, and then some. The same principle applies to the stock market. If you look at the history of the S&P 500, most trading days are unremarkable, but a handful of extraordinary days, think post-crisis rebounds, historic bull runs, account for the majority of total market returns. If you missed just the best 10 days in the market over the last 20 years, your total returns would be cut in half. So what does this mean for you? It means you should stay invested, even when things look scary. The tail events, the big wins, are unpredictable. You can't time them. The only way to capture them is to be in the game.
It also means you shouldn't be discouraged by failure. Most of your financial decisions will be average, but if your strategy is sound, the few big wins will more than make up for the losses. This is how the world's greatest investors think. Now we get to what Housel says is the highest value that money can provide. And it is not luxury, it is not status, it is not toys or travel or experiences. It's freedom. Specifically, the ability to do what you want, when you want, with who you want, for as long as you want. He argues that this freedom, what he calls control over your time, is the highest dividend that money pays. And research backs this up. Studies in behavioral psychology have consistently shown that autonomy, the feeling of being in control of your own life, is one of the strongest predictors of happiness and life satisfaction. Think about what the opposite of financial freedom looks like. You wake up every morning dreading work. You do a job you don't enjoy for a boss you don't respect because you have to. You can't leave because your bills are too high. You can't take a risk on a new career because you have no savings cushion. That's what lack of financial freedom feels like, and millions of people live that reality every day. Now think about what financial freedom actually looks like. It doesn't necessarily mean yachts and private jets. It might just mean taking 2 months off when you need to recharge, turning down a toxic job, starting the business you've always dreamed about, being present for your kids instead of grinding 80-hour weeks. Housel's advice is this: build your finances around freedom, not status. Resist the urge to spend on things that look impressive to others. Instead, invest in building the cushion of time and options that gives you real control over your life. This is one of the most memorable stories in the book, and it's a complete gut punch to the idea of buying expensive things to impress people. Housel writes about a time he worked as a valet parker at a luxury hotel. He would see people pull up in Ferraris, Lamborghinis, and Porsches, beautiful, jaw-dropping machines, and he noticed something fascinating. He never once looked at the driver and thought, "Wow, that person is cool and successful." Instead, he just thought, "Wow, what an amazing car." And he realized that's what everyone thinks when they see a fancy car. They admire the car. They fantasize about owning that car themselves. They don't think about the person driving it. The driver buys the car because they want people to admire them, but the observers are busy admiring the car. The status signal the driver was hoping to send was completely lost in translation. This is the man in the car paradox, and it applies to luxury houses, designer clothes, expensive watches, and every other status symbol people buy to look successful. The takeaway? Spending money on things just to signal wealth to others is one of the least effective investments you can make. It's wealth destruction, not wealth building. True wealth is invisible. It's the investments you've made, the savings in your account, the debt you've avoided. No one can see it, but it's the only kind that gives you real security and freedom. Building directly on the last lesson, Housel makes one of the most counterintuitive statements in the book. Wealth is the nice cars not purchased, the watches not bought, the first-class upgrades declined. In other words, wealth is not what you spend, it's what you save. We live in a culture that constantly shows us what rich people spend money on. Social media is full of mansions, vacations, jewelry, and designer brands, and we naturally assume that's what wealth looks like. But here's the thing. The person driving a 10-year-old Honda Civic and eating at home might be worth 10 times more than the person leasing a BMW and dining out every night. Because true wealth is accumulated by not spending money. Every dollar you don't spend is a dollar that can grow and compound over time. Now, this doesn't mean you should never enjoy life. Housel is not saying be a miser. He's saying be intentional. Spend on things that genuinely bring you joy and align with your values. But don't spend just to look wealthy, because looking wealthy and being wealthy are almost always opposites. Here is a lesson that sounds incredibly simple, but most people get it completely wrong. Housel says you don't need a specific reason to save money. Most financial advice tells you to save for something: a house, retirement, a vacation, your kid's education, and those are all great reasons to save. But Housel argues that the most powerful savings behavior is saving just to have savings. No goal, no target date, no specific purchase in mind. Why? Because life is unpredictable. The best investment opportunities often appear without warning. The worst emergencies also appear without warning. If you only save for specific goals, you'll be caught flat-footed by the unexpected. But if you have a healthy savings cushion, savings that aren't earmarked for anything, you have flexibility. You can take advantage of a market crash and buy stocks at a discount. You can weather a job loss without panic selling. You can take a career risk. You can say yes to an unexpected opportunity. Housel calls this the option value of savings. Your savings account is not just a pile of money, it's a pile of future options. And the more options you have, the more in control of your life you are. His recommendation? Save more than you think you need to. And don't worry if you don't have a specific goal in mind. The goal is freedom, and freedom is always worth saving for. One of the most practically useful ideas in the entire book comes from this chapter. Traditional finance theory says you should always make the perfectly rational financial decision, the one that maximizes returns according to a mathematical model. But Housel says that approach is deeply flawed, because humans aren't robots. He argues that it's better to make a reasonable financial decision that you can actually stick to than a perfectly rational one that you'll abandon the moment things get uncomfortable. Here's a perfect example. Financial theory says that investing 100% of your retirement savings in stocks is the optimal strategy for long-term growth, and mathematically, it's hard to argue with the historical data. But here's the problem.
When the market crashes 40%, and it will at some point, can you actually stay the course? Can you watch your retirement account drop by nearly half and not panic sell? Most people cannot, and the worst financial decision you can ever make is selling your investments in a panic at the bottom of a crash. So Housel says it is perfectly reasonable to hold a more conservative mix of stocks and bonds, even if it means slightly lower theoretical returns, if it means you can actually sleep at night and stay invested through a downturn. The best investment strategy is the one you can stick with consistently through bear markets and bull markets, through fear and greed, through recessions and booms. Do not chase perfection, chase sustainability. In this chapter, Housel makes an important and humbling point about financial forecasting. He says, the most important economic events are always surprises. The 2008 financial crisis was a surprise. The COVID-19 pandemic and its economic impact were a surprise. The dot-com bust of 2000 was a surprise. World War II was a surprise. The rise of Amazon, Apple, and Google was a surprise. History is driven by outliers, extreme, unprecedented events that virtually no one predicted. And yet, after each one happens, we immediately start building financial models as if we can predict the next one. Housel's point is not that we should not try to plan. His point is that we should build our plans to survive the unpredictable. We should assume that something surprising will happen. We just do not know what or when. Practical applications? Never assume your financial projections will be exactly right. Build in a generous margin of error. Do not make concentrated bets based on a single predicted outcome. Keep your lifestyle costs below your income so you have room to absorb shocks. Maintain liquidity, cash or easily accessible savings so you can survive surprises without making desperate decisions. Following directly from the last lesson, Housel introduces one of his most important concepts, the margin of safety. Originally a concept from value investing, popularized by Benjamin Graham, Housel applies it to all of personal finance. The idea is simple. Always assume things will go worse than you expect and plan accordingly. If you think you need $1 million to retire comfortably, save $1.5 million.
If you think you can handle a 30% stock market drawdown, prepare emotionally and financially for 50%. If your business plan projects breaking even in 12 months, plan for 24 months. This is not pessimism, it is realism, because the future is inherently uncertain, and those who thrive financially are those who have built enough buffer to absorb the unexpected without catastrophic damage. Housel says the margin of safety is the only way to navigate a world that is uncertain. And the key principle is this: avoid ruin at all costs. In investing and in life, the goal is to survive long enough for good things to happen. If you make a single catastrophic financial mistake, leverage too much debt, make a massive undiversified bet, drain your emergency fund, you may not get a second chance. Stay in the game, protect the downside, and let time do its work. Here is a truth that most financial planning ignores. You are not the same person you were 10 years ago, and you will not be the same person 10 years from now. Your goals will change, your values will change, your risk tolerance will change. What makes you happy will change. Housel calls this the end of history illusion, a psychological phenomenon where people recognize how much they have changed in the past, but assume they won't change much in the future. This creates a dangerous financial trap. You might make a 30-year financial commitment, a mortgage, a career path, a retirement plan, based on who you are today, but who you are in 20 years might be completely different. So what do? Housel doesn't say to avoid long-term planning. He says to build flexibility into your plans. Avoid locking yourself into financial commitments that are impossible to reverse. Keep your investment strategy simple enough to adjust as your life changes. Don't feel guilty about changing direction when your goals evolve. That's not failure, that's wisdom. Revisit your financial plan regularly, not just the numbers, but the underlying goals and values driving those numbers. One of the most powerful reframes in the book: every investment return comes with a price, and that price is volatility and uncertainty. Housel compares market volatility to an admission fee at an amusement park. You don't enjoy the rides for free. You pay the entry price, and that's okay. The experience is worth it. The problem is that most investors try to enjoy the rides without paying the fee. They jump in and out of the market trying to avoid the downs and only capture the ups, and in doing so, they destroy their returns. The fee for long-term stock market returns, which have historically averaged around 10% annually before inflation, is the emotional discomfort of watching your portfolio drop, sometimes by 10%, sometimes by 30%, sometimes by 50%. That discomfort is the price of admission, and it's worth paying. The investors who refuse to pay it, who panic and sell at every downturn, end up with far worse returns than those who simply stayed the course through the turbulence. The lesson? Embrace volatility. Expect it. Normalize it. It's not a sign that something is wrong. It's the natural cost of long-term investing, and the investors who understand and accept this are the ones who come out ahead. This is one of the underappreciated lessons in the book, and it's especially relevant in today's world of financial social media, Reddit investment forums, and YouTube finance channels, including, ironically, channels like this one. Housel makes an important point. Different investors have different goals, different time horizons, and different risk tolerances. What makes sense for one person may be completely wrong for another. He uses the example of a day trader and a long-term retirement investor. Both might be talking about the same stock, but they're playing completely different games. The day trader wants to capture a short-term price movement. The retirement investor wants to hold for 30 years. The same stock tip from a day trader could be catastrophically harmful advice for a retirement investor, and vice versa. The danger? In the age of social media and investment forums, everyone's financial opinions are mixed into the same feed, and it's very easy to take advice from someone who is playing a completely different financial game than you are. Before you follow any financial advice, including this video, ask yourself, is this person in a similar financial situation as mine? Do they have the same goals and time horizon? If not, their advice might not apply to you. Know your game and only take advice from people who are playing the same game. Housel makes a fascinating psychological observation here. Pessimism always sounds smarter than optimism. When someone predicts doom and gloom, market crashes, recessions, systemic collapse, they sound serious, thoughtful, intellectually rigorous. People share their predictions, they get media attention. When someone says, "I think the market will keep growing over the long term," they get eye rolls. They sound naive, boring, like they're not taking the risks seriously. But the reality is, the long-term trend of human economic progress is overwhelmingly positive. Despite wars, recessions, pandemics, and crises, the global economy has grown consistently over centuries. Living standards have risen, technology has advanced, poverty has declined. The pessimists have been wrong, on balance, over the long arc of human history. Now, does that mean you should be blindly optimistic? No. You should always be aware of short-term risks. You should always manage your downside. But you should not let short-term pessimism destroy your long-term financial strategy. The most successful long-term investors, Buffett, Charlie Munger, Peter Lynch, are all optimists at heart. They believe in the long-term growth of the economy and human ingenuity, and that belief gives them the conviction to stay invested through every crisis. Be a long-term optimist. Be a short-term realist. This chapter is about the dangerous role that narrative plays in financial decision-making. Housel argues that humans are story-driven creatures. We crave explanations. We need things to make sense. And when reality is chaotic and uncertain, as financial markets always are, we instinctively reach for narratives that explain what is happening and predict what comes next. The problem? We will believe a compelling story even when the evidence is thin. And financial markets are filled with storytellers, analysts, commentators, influencers who are very good at creating confident, compelling narratives. Think about how many times you've heard someone explain exactly why the market went up or down on a given day. The news anchor says, "Markets fell today due to concerns about inflation." But did they really? Or did 1,000 different factors, many completely random, combine to produce that outcome? The lesson is, be skeptical of confident financial narratives, including your own. When you find yourself absolutely certain about where the market is going, take a step back. History is full of people who were absolutely certain and absolutely wrong. Make your investment decisions based on process and principles, not on stories and predictions.
In this chapter, Housel brings all the lessons together and gives his practical financial philosophy. Here is a summary of his core principles. 1. Save as much as you possibly can, more than you think you need, without a specific goal if necessary. 2. Invest in a diversified, low-cost index fund. Do not try to beat the market. Track it. 3. Avoid lifestyle creep. As your income rises, keep your lifestyle costs relatively stable and funnel the difference into savings and investments. 4. Think long-term, decades, not years. Compounding needs time to work. 5. Leave room for error. Always plan for things to go worse than you expect. 6. Avoid single points of failure. Never put yourself in a position where one bad event can wipe you out completely. 7. Define enough. Know what a good enough life looks like for you, and stop chasing beyond it. Housel acknowledges that this is not an exciting strategy. There are no hot stock tips, no get-rich-quick schemes, no secret formulas, just discipline, patience, and emotional intelligence. But here's the truth. Boring financial strategies win. Consistently, year after year, the people who follow simple, boring, disciplined financial principles end up wealthy, while the people chasing excitement and shortcuts often end up broke. All right, let's bring it all home.
After going through every lesson in The Psychology of Money, here are the 5 big ideas I want you to walk away with today. Number 1. Your behavior matters more than your intelligence. The biggest financial variable is not your IQ. It is your ability to manage your emotions, to stay calm when markets crash, to resist the urge to overspend, to stay patient when compounding is slow. Number 2. Time is your greatest financial weapon. Start early. Stay invested. Give compounding the time it needs. Every year you delay is a year of potential growth you can never get back. Number 3. Define enough before you reach it. Set clear, meaningful goals for your financial life and resist the temptation to constantly raise the goalposts. Knowing when you have enough is the foundation of true wealth. Number 4. Build financial freedom, not financial status. Use your money to buy time and autonomy, not to impress other people. The true measure of wealth is not what you spend, it is the options and freedom you have. And number 5, stay in the game. Avoid catastrophic mistakes. Maintain a margin of safety. Embrace volatility as the price of long-term returns. And above all, never let fear or greed knock you out of the game before compounding has had a chance to work its magic. That is our full breakdown of The Psychology of Money by Morgan Housel. I genuinely believe this is one of the most important books you can read, not just for your finances, but for your life. Because at the end of the day, money is just a tool. The real goal is freedom, security, and living on your own terms. And that starts with understanding yourself, your biases, your emotions, your habits, and learning to make smarter choices with the money you already have. If you got value from today's video, please do us a huge favor and smash that like button. It helps the algorithm show this content to more people who need to hear it. And if you're new here, welcome to Mono Invest. This is the channel where we take the world's most powerful financial ideas and break them down in a way that actually makes sense. Hit subscribe and ring that notification bell so you never miss an upload. And drop a comment below. I want to know, what was your biggest takeaway from The Psychology of Money? Let's talk about it. Next week, we're breaking down another incredible book, so make sure you are subscribed so you don't miss it. Until then, keep learning, keep investing, and keep building the life you deserve. I will see you in the next one.